Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. Most investors rely on gut feelings, shiny brochures, or hype, and that's exactly how people miss red flags and lose money. At Break of Day Capital, we do things differently. We help investors make smarter decisions before the deal ever hits your inbox. From our educational webinars to our Invest Smart book to real tools like our portfolio tracker, we're here to give you the edge most investors don't even know they need. If you've been valuing our podcast and want to take the next step, subscribe to our newsletter. You'll get early access to webinars, new investor tools, and market insights sent straight to your inbox. Break of Day Capital, because smart investing starts before the deal. Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes. Today on the podcast, we have my good friend Omar Khan back. He was on episode 83 over 4 years ago. When I looked, I was like, oh my God, I can't believe it's been 4 years.
Oh, Lord. Okay. Wow. That does make me feel old now, Gary.
Omar is a founder and managing partner of Boardwalk Wealth, focused on multifamily assets in the Midwest and Sunbelt. Well, welcome to the show, Omar. Tell the audience a little bit more about yourself and what you do.
Well, Gary, I might have had the last appearance 4 years ago, but I do feel like I've aged at least 10 years since that appearance. And for very obvious reasons that are going on in the market. So I'm the founder and principal at Boardwalk Wealth. We just do multifamily. We do acquisitions, developments. We're acquiring a lot of distressed assets as well. Look, we've done about 800 million in transactions. My background's in capital markets, investment banking, and we're now, I hope, on the cusp of sunnier days after the last 2 or 3 years of just the industry going sideways or negative. But that's maybe what Gary and I were discussing a bit of that. Maybe we'll touch on some of the painful raw points during the podcast, but let's go for it.
Yeah. I mean, we're definitely seeing in the, sunnier days ahead, but that's on the stuff that we're buying, which is a great base. It's those 2022 legacy properties that we have that are having to navigate through because that basis has lost 35% of value, roughly across the board, not even including operations. So if you have really good operations, maybe it's 25%. If you had bad operations, then you've probably lost
but at that
property.
stage, it's a bit like saying, do you want to get hit with 5 bullets or 10? You're dead either way.
Yeah. How are you navigating the 2022 deals, your loans and stuff like that, given where the value has for all of our properties have lost so much?
Well, first of all, the first thing I'd like to say is I'm grateful that at least you're honestly acknowledging this, because for the vast majority of people I talk to on a public forum, podcasts are sort of like a public forum. It's been very, very interesting because they're like, look, everybody else is in trouble, but I walk on water. I am this one unicorn that is just floating above everyone else. I mean, I was on a panel in Los Angeles. Oh, we might have been at the same conference, right? The Family Office Club one, right? In Los Angeles. Were you there? I don't know if you were there.
No.
Anyways, I was in SoCal. I just assumed you were there, right? And I was talking to a few folks, sort of like a panel. And one of the operators there, I mean, there's a guy I know. We've known each other for a little while. He was just like going on and on about how great they're doing, how awesome they are. They're out of Phoenix, how amazing everything is. And I didn't want to be rude and be like, look, man, your lender, as part of their lender blast, not just to me specifically, has already shared 2 of your deals that they are potentially foreclosing on. And this guy was pretending he's walking on water. Okay. So what I want to say is I give kudos to you. You're upfront. You're honest about this. Everyone in the industry, and this is not a syndicator or private capital problem, Blackstone, KKR, Apollo, Brookfield, you name it, they have all returned multiple billions with a B, of real estate. They have been foreclosed upon. And this is supposedly the smartest people in the room, right? So this is a problem that's afflicting everyone from the mega private equity corporation, say some guy on Upper East Side in New York, all the way down to the syndicator level. So this is something that's pervasive. Now, how do you get out of these problems is something else. But part of this is also baked in how you got into these problems. If you got into these problems and look, you overpaid by 5 or 10% and your operations are good, you've got a solid team, you're diligently focused on working away on it, there could be hope, right? I mean, there's a lot of moving parts there, right? But look, if there is a gross basis reset in the sense that if somebody is buying Class C assets in certain markets, say for 250,000 units, there are certain markets like that. People in Texas would be surprised, but Western Coast and those markets have it, right? And now that Class C value has dropped in some cases 50% in those markets. Well, you're not making your way out of that. I don't care how good your operations are. I don't care how much rates go down. You have a basis problem. It's a bit like buying a Toyota Camry at $300,000. It's a great car. It's not worth $300,000, right? So that's basically what the situation is right now. With regards to us, luckily, I mean, while we've had our share of problems, we've refinanced agency refinanced a couple of assets, fixed rate agency financing. Gary and I were just, I'm going on and on, right? Gary and I were just having this chat. Gary was like, well, are you comfortable with a 5-year term? And I was like, well, I feel 5 is a lot better than a 1-year extension, right? Where you get your face ripped off and you've now put more money into the asset. So we're really hopeful, hopefully these are not famous last words, that we complete another refinance this week. And then we'll just start praying to the Lord, I guess, after that.
Well, congrats on finishing another refi, because lenders just dragging their feet in the mud, and you got to get them to play ball. And some lenders are great to work with, and some are really, really tough to work with. So it's very, very difficult to navigate these waters. Even on a new deal, there's just a lack of lenders out there right now.
Yeah, look, I agree with you to a certain degree. I think the other issue also is that I feel like here's my opinion. Like, try to get, again, everyone's situation is different. I would veer towards getting agency loans right now, even though I've done multiple agency loans and refinances, probably over like a dozen now, right? And the sheer amount of questions on, like, we're talking on down the fairway. I mean, look, we closed on this deal. I think it was 7 years term, 4.975% fixed rate interest. Great. I mean, it's down the fairway deal, right? The amount of questions I got asked about like really stupid things. I mean, I got asked questions about a deal from one of the lenders. I was going to say their name, and I don't want to be sued, right? Agency loan, where I had actually had the agency loan 2 or 3 years ago, probably 3 years ago. Another guy bought the property off of me, but took over the agency loan. So now I'm done. They approved that. This is 3 years ago. They're asking me questions. Oh, we see there's outstanding CapEx. I'm like, I don't even own this property for 3 years. What are you talking about? This is the state of like colonoscopy they want to do on you, right? But hey, once you get through it, if you get through it, getting a 5% or 5.2% rate beats having a 7 or 8% rate every day, right?
Yeah.
So that's the way I
absolutely.
get it.
How was it difficult getting your investors on board to know that you're taking a deal that maybe was 3 years in, and you're going to extend it possibly another 5 or 7 years? Was that difficult?
I mean, no, it was great. Very. I had a phenomenal time. It was awesome. Everybody was clapping. They were sending me cigars and champagne. No, look, I think what helped us, I'm using the term liberally here, right? Helped us was the fact that from day one, we have been proactively communicating. We've always proactively communicated the good, the bad, and the ugly. So it wasn't like, a couple of years into this, it wasn't like it was a surprise, because look, they are also invested in a lot of our transactions that they're getting cash flow on, distributions on, refinances on, all of that stuff. So they can see over the arc of their relationship with us that whether it's good, bad, or ugly, we share all of the information in a transparent manner. So yeah, it wasn't like it was a surprise for them, right? It wasn't like we got to the finish line and we're like, oh, by the way, this is a great asset. Surprise, it was a bad asset. None of that stuff happened. So I don't think there was as much. I mean, I'm not saying people are related, right? I'm not saying they're ecstatic about this, but there wasn't as much of a pushback as I would have even imagined, or people, because most people by and large are reasonable. And I feel like if they see you're transparent, you're upfront, you're doing the work, you're showing up every day, then I mean, that's all you can ask for. But yeah, to answer your question, were people ecstatic, elated, happy? I can't imagine that. Nobody was clapping for me. But they understand because they can see the work we're doing and they're transparently with how much. Look, in certain cases, we have actually doubled the NOI. No joke, literally doubled the NOI. And because of the punitive actions of the interest rates, we're now scrambling. Think about it. You double the value of something. That's how, in some cases, or in certain markets, or the way the certain lenders look at it, this is how the situation can be viewed as. So people get it, they understand, but again, you got to be proactively communicating with folks.
100%, 100%. And the alternative is, you're giving, real estate is all about time, and if you give it enough time, you'll get back where they could not only get their money back, but probably some kind of return. Where if the alternative is they could have lost all their money on the deal, and a bunch of people have, because they weren't proactive, they didn't communicate, and they couldn't do a capital call or navigate a refi, and they're screwed. I mean, there's a bunch of people out there that have lost, plenty of deals. Now, it's not rampant in the industry, but we're all facing this basis problem.
Well, I can tell you this. So far, we did flirt with the idea of doing a capital call. We didn't do a capital call. I mean, that was very stressful last year, varying in between. One of my partners on a deal, Sam and I, a great guy, we put in $2 million of our own money into the trial. Again, that's why last year was very stressful. But the fact of the matter is, I think when you can show that you've taken these steps, then you can go to sleep at night, right? Because you can show, hey, man, look, we put $2 million of our personal funds into this thing. I don't know what else you want me to do here to show more skin in the game. Number one. Number two, there is a lot of distress. We've taken over 2,000 units from lower to middle market sponsors and syndicators. There is an ample amount of distress. We have taken over these units. But to my shock, what I'm realizing is that a lot of folks basically would have had that flipper mentality where, hey, I mean, literally, I've had people tell me we've taken over some of their assets. Hey, I just thought, if things got worse, I could just sell out of it. No problem. I was like, this is not like the stock market, man. You can't just like click a button and stuff happens. But that's kind of the mentality a lot of people had. So, yeah, I don't know what to tell you. It doesn't make it better, but right. It's actually kind of shocking that a lot of people actually literally believed it. I've had a couple of guys tell me, I never thought real estate could go down in value. And I'm like, my man, you're older than me, right? I'm 40. You're older than me. You're like 50 something. How did you totally forget 2008? Like, what happened? Like, were you high? Were you sleeping? What was the deal? But people genuinely believe this stuff.
All right, well, let's talk about opportunity. I know you mentioned earlier you had bought some distressed deals. Were they from the lender? Were they from the broker? Like, how did you get this opportunity?
So it's a combination of borrowers and lenders, because we are basically, again, we are approved with most major bridge lenders and agencies. So what happened, during the good times, nobody gives a shit. Nobody gives a shit if you're reliable. Nobody gives a shit if your operations are good. Nobody cares that you follow up on your word and do what you say and say what you do. Nobody gives a shit, okay? But during the bad times, these things are very valued. So during the good times, when you're like, okay, well, this other guy doesn't even follow up on his commitments, totally is like fly by the seat of his pants type of deal. This person is scaling up like crazy. What the hell's wrong with me? Well, the flip side to this is, on the other side of that coin, during the bad times, all your years of reliability that were grossly undervalued, they become overvalued now. They become even more valued than they should be valued, just to be clear. So because we had gone full cycle with a bunch of lenders, we're always paying our bills on time. We don't have deferred maintenance, right? Because a lot of these assets, the problems lenders we were telling them, but they quickly realized after a little while was that, yeah, look, you can try to squeeze all the money out of your borrower, like these distressed borrowers that we took from, but what's going to happen is they're not going to take care of your collateral. So none of the capex, none of the deferred maintenance. So effectively, you'll drag this process out for 6 months, but in that 6 months, your collateral will become worse, your leasing will become worse, everything is going to go haywire, right? But it takes a little while for people to realize because everybody has their own set of challenges. So this was a combination of going through lenders and borrowers and putting accretive structures in place that basically restructuring the loan agreement, going through the entities, which then allows us to basically not have to have the lender show a foreclosure on their records. Because you have to realize, as much as the borrower foreclosure is a problem, for a lot of publicly traded entities, the more loans they have that are watch listed. Watch listed are, hey, this loan can become trouble, right? Or the more loans that they foreclose upon, the market also views them in a negative way because the market says, look, you cannot, this means you do not have the discipline to originate loans in a timely manner. So, yeah, obviously to the borrower, it's a way bigger problem, obviously. But to the lender, if they're publicly traded, it is a problem as well. Of a much smaller and lower level, but it is a problem. So coming in, trying to solve that problem. And again, I wish I could tell you that there was an algorithm, you come do this and it's done. This is an ever evolving problem because it's not just the lender or the borrower issue. Then there are personal issues, right? Let's assume somebody is a mid-level, they're like mid-40s, early 50s. They worked all their life to become a CIO of a bridge debt fund. Well, the last guy might have originated loans, but they're the ones left to handle the mess. Now it's a career risk for this guy, right? Because if this thing goes sideways, there's not a lot of demand for mid-tier CFOs in the market that are over 50 years old. So you get into psychology and other aspects as well, basically.
And earlier you mentioned how important it is to do what you say you're going to do, because that's one of the multiple deals where the broker knows good times are bad. I'm going to close. I'm going to do what I'm going to say. I'm going to communicate what's going on, and that is such a tremendous value to a broker, to a lender. It really, really goes a long way, and unfortunately, a lot of people, aren't don't stand by their word.
Exactly, right. But again, in the good times, nobody cares, man. Nobody gives a shit, right?
Right.
So I just wanted to point that out. Nobody. So, I guess you just have to stay disciplined. And again, you'll still have problems even if you stay disciplined, but hopefully you'll have less problems.
So has your strategy changed in the last year, 2 years on how you're looking at properties or underwriting or how you manage a property?
Look, I don't think change is the right word. Refinements, I think, is the right word because change implies like some wholesale change, right? At least to me. Obviously, going through the last 2 or 3 years, our team has codified a lot of our asset management processes in a more deliberate manner. Obviously, every month, every quarter, every year, our internal reporting and external reporting is improving. It's getting a lot better. We're focusing on levers much more quicker. Even I thought we were doing a great job earlier, but much better. So I'm very grateful for my team. Basically, an internal organization has become much better. But in terms of wholesale changes, I think there is less of a wholesale change and more constant tinkering and refinement, which, by the way, because we all have recency bias, right? We just remember the things that are in literally the last couple of days or months, whatever. So if I was to actually take out basically a list of things we've done over 3 years, that would be a very long list. But so I don't want to trivialize that, but it's just that when I see it in the context of sitting here today, I'm really only looking at the last month or 3 months. So lots and lots of refinements. But yeah, if I was to sum up all of those things over 3 years, then I could say, oh, yeah, there are significant changes. But I'd say we have to look at it more from sharpening our tools and our perspective as opposed to a wholesale change in what we're doing.
Yep. If you're not getting better, you're getting worse because someone else
Yeah.
is coming up with new ideas and whatnot. And that new idea could come from someone that's even just started out and not hasn't been in the business for 10 years. You never know where a
Yeah.
new idea or a new refinement is going to come. But yeah, we're constantly trying to iterate, tweak things to improve how we operate, how we do everything.
Yeah, but look, Gary, if I had this work ethic like earlier in my life, man, I'd be rich, dude. Like the amount of follow-ups, investors, lenders alike we've had to do, it's yeah, man, if we did this all during our whole life, we'd be like crushing it, man.
Yeah. So, I know you don't have a crystal ball. What do you foresee in the next year or two regarding maybe distressed assets, basis? What do you see? What's your thesis?
So first of all, I'm not of that opinion that fundamentally things are going to materially improve in the next year and a half. Like it's not like okay, can it improve? Yeah, but I'm talking like fundamentally improves means because I'll give you an example. I live in Dallas. I don't own a lot of assets here, right? But to give you some context, from the outside looking in, Dallas is viewed as a really good market, right? I mean, people are moving to Dallas. It's considered a city on the rise and all of that sort of stuff. This is now the 29th or 30th month in Dallas with sideways or negative apartment rents, just so that you have some context. Because if you just hear the media, see what's going on, you would think the streets are paved with gold in Dallas. That's not really the case. So what I want to say is, can things improve? Yeah, but things are potentially going to improve if they're not negative, they're break even. So that's an improvement, but you're not crushing it if that happens, right? So I don't necessarily think fundamentals are going to improve in the coming year at all. I think if anything, they might stabilize, maybe improve a little bit. All this supply, the supply dwindling and supply cliff that we hear about, I think it's going to take a little bit longer than people anticipated will. So I think in that regard, it's going to be a slog for the next year or two. But I do feel a lot of the transactions and a lot of the folks and a lot of the people that actually get deals right now, even though it sucks, are going to be the clear winners going forward. That's what
I
I think.
agree.
What do you
I've
think?
I've had an overly optimistic view, or previously, and unfortunately, I am an optimist. But yeah, the reality is, yeah, it's just not. There's not some miracle cap rate compression, rent growth, whatever it may be to save you. It's time and slight improvements over a while.
That's what I feel, right? And the other thing that I'm again, I'm hearing this again. This was something that was grossly, I think, undervalued during the good times. Was the fact that I think it pays now, or I'm hoping in the coming years, it will pay to know how to run your assets. Versus for a few years in between, it actually didn't really matter. In fact, if you spend any money on operations and refining that was a net loss because you should have taken that same amount of capital, put it towards marketing, gotten more investors, done more deals, made more fees, made more money. Right. So I do feel we're heading into a direction where actually running and operating our assets is going to be accretive, hopefully. But again, that's not a thing that I feel people will actually see in the next year. But what I do feel is with all of this thing, in the next year or two, there will be more and more opportunities to pick up distressed assets. Now, the counter argument to this is, how do you go raise the equity? That's the one thing that I feel a lot of people are not focusing on, because everybody says, oh, I can get a good deal. I was like, great. Where's your equity coming from?
Talk about a slog there.
Yeah, right. So that's, I think, that I think is not going to be easy. Like, what's your take on it? I mean, what do you see?
Well,
Because we're in different markets, right? So
capital,
you could have a different view.
no, raising capital has been really, really tough. I mean, certainly you have your a lot of the investors that have not gotten distributions on deals, or their money's tied up in a deal, or they've had capital call with other operators. So there's not that liquidity. They've done well in the stock market, Bitcoin, gold, and silver. Now, obviously, there's some pullbacks, but it's done relatively well. So I've seen an uptick in tech money coming in to invest in multifamily, but it's not the FOMO that you had, 19, 20, 21, 22. There's a tremendous lack of urgency for people to come in. They might think about investing. I mean, some people come in right away, and some people it might take 2 months for them to wire in their money, and a lot of deals are closing, and you're finishing up the raise, 1 month, 2 month, 3 months afterwards, and that's fine to get the deal done.
And
But
that never used to happen, right? That
right,
never used to happen. Yeah. But hold on. So look, I'm on the eastern side, right? I'm Sunbelt, east side, Texas, Georgia, Florida, surrounding markets. You're prominently in Arizona and some of those other markets. So in those markets, what are you seeing? Do you think fundamentals are improving significantly? Not at
um, there have been times where I'm like, yes, we're out of it. We're looking positive, and then like we go backwards again. Um, And so we're starting to see in some of our properties a little bit of rent growth, getting rid of some concessions. There's still a lingering delinquency that we've had higher the last couple of years than we've ever had. So we're hoping there's some really good rent growth supposedly coming based on Yardi and CoStar and RealPage. We'll see, but that's not this month. Probably second half of 2026.
Dude, but I
Um,
think people have been saying second half since the first half of
right.
20. They said second half of 2025. Then
Yeah.
I get into second half, they're like, okay, first half of 20. So that 6 month target keeps going ahead, I feel. I'm not, this is not against you. I'm just
Yeah.
saying, bro, everybody keeps saying that.
Right. And from a geopolitical standpoint, I mean, we've had a lot of self migration and a lot of obviously in migration has subsided tremendously, which hurts apartment owners. So that has had an effect. Also, for us at the University of Arizona, we have 12,500 less foreign students there. And
What? Hold on, hold
yeah,
on, hold on. Over what period of time? Do you have 12,500 less foreign students?
this school year.
How, dude? Okay. What is the total people that go to University of like Arizona?
Oh, I mean, it's a huge university, like over, like I think
No,
around
no,
like a
the one
hundred
where you
thousand.
are talking about, right? So
Yeah,
like,
like 100,000 people.
so that is a huge decline, man.
Oh yeah, and so it's not. We own 8 properties in Tucson, so I mean, 12,500 people is not a lot, but that could be like 1% that affects us. And then if you have self migration and less in migration, again, you're adding these percentage points that affect your occupancy. And
Wow, that is a
yeah,
huge number. Wow. I
yeah,
knew it was bad. I didn't realize it was because look, in full disclosure, pretty much everywhere, at least on southeastern side, right?
yeah,
Even in the Midwest, any Hispanic properties that and Hispanic residents used to be the gold standard. I think they still are the gold standard for workforce housing, right? I mean, I don't know what it is, but even in a recession, some of these people have like 5 jobs to a person, which is like credit to them, which means you get your rents paid on time. And in the last year or so, I'm not a political comment. I always want to give that disclaimer. We're just talking about what we're seeing, what Gary and I are seeing. And a lot of workforce housing that used to be, at least in Texas and Arizona, I'm assuming, very Hispanic focused, right?
yeah.
They're seeing huge dips in occupancy and collections. I mean, one of the lenders was telling me it was a bigger property. It was way big above our buy box. It's a 300 unit property in Houston. It was like late 90s because there's nothing early 90s in Texas. 300 or 400 unit properties owned by a very big, sophisticated operator out of Dallas. The broker was telling me they lost 100 units overnight when the
Wow.
initial ice and all of this stuff started happening. 100 units. Think about it. I mean, I don't care like how good you are. Recovering from 100 units overnight skips and all of that, that's gonna cause a lot of problems.
Yeah.
So
Yeah,
yeah,
that's
wow.
that's going to take a year to work through.
Oh wow, man. Holy moly. Way to be a
Yeah.
ray of sunshine, man.
All right. Well, Omar, this was a great discussion. I appreciate your frankness. And I'm glad you're doing well. Um, where can listeners find out more about you and your company?
Well, you can always go to our company website. It's www.boardwalkwealth.com. Again, the form is right on the homepage. That's at boardwalkwealth.com.
Awesome. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.